Welcome to this session. I certainly am really looking forward to learning a lot, and I hope that for those of you who join the session, have your notepads and pens and things ready. So, and I hope I'm going to pronounce your name right. So please do correct me if, if I'm wrong. Elianne, oi, how's that?
Yeah, pretty
Yeah,
close.
yeah, yeah,
Elianne. Yeah, it's
yeah,
a,
yeah.
it's a, it's a French slash Dutch name, so it's
There
Elianne.
you go.
Call me Ellie in English, much easier.
Ellen, yeah, Elianne. She's the co-founder and investment community at Futuristic Collective, which is a great name as well. And not only an adventurer at heart, Ellie also helps founders get investment ready. So you offer a really deep check on the business model, and you share quite a different view and some different options for people to raise funding to get them ready to scale their business. So welcome to Base, and I look forward to learning more about you and your session. Thank you.
Thank you. Thanks for having me. I'm very excited to have you all here. It's a small audience, so I'm hoping it'll be slightly interactive. So even though you can't turn your cameras on, I'm going to ask you a few questions, and I'm hoping you can stand and type. So I'm going to ask you a question. If the answer is yes, you stand up. You too, Estelle. See how this works. Like,
There you go.
are you working in a startup or scale up when you stand up? It's just like my way
I'm in a
of
very tiny phone box.
making sure that you actually are here. So the slide is, I think you sit down again.
Yeah.
I have no idea. So put your hand up. I'm sure, is there an emoji here in the type thingy? No, you can't
Let's
put, it's like
see.
the downside of Hopin. They don't have emojis.
No, they don't have emojis.
Put your hand up if you're in a startup or scale up, then it's good to know. Yes, one yes. So 9 others. Oh no, 8 others unaccounted for. Yes, anyone? Okay. Put your hand up or stand up if you want to preferably go outside instead of sit behind a Zoom screen. Like me, please. Yes. 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 Okay, sit down again. Okay. Put your hand up if this is the second or third conference this week that you've gone to. It's conference week, guys. It seriously is. It's shocking. Okay, last one. Put your hands up, stand up if you are wearing something red. Ooh, look at that. Oh yeah, you are wearing red. Very good. I'm not wearing anything red, unfortunately. Ooh, red nails. Very good. Very good. Well, thanks for playing. The reason why I do this is because as you stand up and sit down, your energy starts flowing again. So I'm not sure about you, but if I sit behind my computer for too long, my feet get really cold. I get really cold in general. It's like my energy just basically my body goes to sleep. Not that I want to bore you with that kind of detail, but I wanted you to move a little bit after kicking off this conference. And I know what it feels like to just sit still. So there you go. We've just moved. High five. In for the win. I had in my slides the question, are you wearing pants? But given that I can't see you, it doesn't really matter. So there you go. Lucky you. Okay, I'm going to try and share screen. Which I'm not able to, I don't think. Are you able to enable that or not, Estelle?
Let's see. No, I'm not able to enable that.
Yeah, let me see. No, can't fix that.
And even you should okay, maybe if I just close my video and then see if that gives you some more options.
If not, we'll just have to listen to me talking, which may get boring a little bit. It's like I don't have props, so I can't entertain you that much. All good. Look, the reason I did the standing up, sitting down is for the energy. I do this also in most of my engagements with people because I believe that first and foremost, we're all human. So for me, the common denominator across any type of business, in any industry, in any country, what I've learned is that first and foremost, it's humans. Like we are everywhere. We're doing the work, and we're the ones that are actually in control. So if we can engage first with yourself and then with the other, things go usually a lot better. So this is why something to keep in mind for yourself. You know, business is about humans. I love the title for the conference, Humanizing Beyond Profit, because this is how I innately am wired, I think. I also believe that this is the way to do business in the future. Social license to operate has become bigger and bigger. I've worked for mining companies, I've worked with oil companies, and I've worked with NGOs and with governments and international aid institutions. So I've seen the whole spectrum, and I must say, still everyone's human, and humans are fickle creatures. So the more you can ground yourself during each session or with in interaction with each other, the more positive the results will be usually. And that's why Humanizing Beyond Profit is all about that for me. It's like, how do we make this work for everyone involved? How do we make this interaction work for everyone involved? But also, how do we make the business work for the community it's in? Because we are all connected. We're not standalone. If I want to put you on a tangent, go and research what Charles Eisenstein has written. I think he does beautiful work in the oneness and the integrated life force and all that sort of stuff. But we're here to talk about alternative investment structures and what I do in particular. And that really starts with the humans behind it. So I want to ask you to think about your big why. I'll share with mine. And the reason why I want to do that is because I think this is what will connect us at that level. I think Estelle has left us potentially. Okay, I should be able to screen share now. Maybe. Oh, yes. Here we go. I'm going to share my screen for you so that you have something to look at other than my face. Lucky you. So we spoke about humanizing business beyond profit. What we'll cover today is a little bit of your why, my why, financial options, ethics model, and exploring adventure, really. And I'll see if this actually works, because now I can't see the chat. Okay, here we go. Sorry, guys, this is messy. Long live AV. AR is AI and AV. AI is easy. AV is hard. So let's move. So my first question was, are you wearing pants? Not relevant because I can't see you, so you're allowed to wear no pants or underwear or whatever. I was at the my why. So as I said before, I've worked on 3 continents: Europe, Africa, Asia, 4 actually, Australia, if you count Asia as a whole continent. And what I found was what really resonated with me with people was people. What then resonated with me as well as wanting to do good. And what really resonated with me was partnerships. And what I found myself in was in a world where I was making good money, not necessarily profiting, helping the planet necessarily, and sometimes also seeing people being disadvantaged by the work that I was doing. So I found my drive, or my why, being wanting to have everyone to have enough. Everyone being, you know, my family, but also people in other countries and all that sort of stuff. So I made that my anchor point, and that was really my intrinsic motivation to get out of bed every day. It's also the reason why I started Epic, but I won't talk to you about that right now. I want to talk to you about what your why is. So I'm going to ask you 3 questions, and I would love for you to share in the chat what you think is your why. So why are you getting up in the morning? And the questions are, if you are wildly successful and you leave a legacy, and you're the next Richard Branson or whoever, what change will you have seen in the outside world? It's like, what is that legacy? Or if you reframe it, if you had a magic wand, what would you wish for? And please don't come with world peace, because that sucks. And then the last one is, if you could describe your promised land, what would that be? So if you want to chat away or put it in the chat, I would love to read it, because I think if you're clear on that, then it all of a sudden becomes really easy to also filter what you're doing and what you're not doing. Because if the what you're doing connects to your why, it's an intrinsic source of energy as well, of ambition. So who wants to share? Why are you here? People, Veronique writes, people are more connected with themselves and nicer, with more compassion to each other. People do not react from ego, but from their heart. So you live then in a world where people are living like that. Beautiful. Oh, Sarah is concurring. Awesome. You guys should connect. Every woman has a mentor and has the courage to connect with someone they are inspired in. See, doesn't it give you the warm and fuzzies just reading these things? Beautiful. Keep them coming. So mine was so that everyone has enough. I think if you look at Google's, I think it's so all the world's information at your fingertips. If you look at Singularity University, is to create a world of abundance. So it's really about the big pictures, like what does the world look like if I'm wildly successful? What do I want to see changed in the world? Dawn says, love connecting people and organizations with the information and support to succeed and meet their goals. Makes me happy. Cool. Excellent. Very good. And Philip, if I'm wildly successful, I would see people around me being more understanding. So again, this is all about the humans, right? It's not like we're focusing on biodiversity here. So this is an interesting trend I'm seeing. Beautiful changes though. I think the hardest part here is that you then have to start living it, right? It's like, well, how do you do that for yourself first and foremost and lead by example? Because I think Daniel Roy spoke about transparency and trust. I think the biggest thing that you can give people is the safety, the psychological safety of being somewhere where they're okay. They're not at risk. They don't have to have a primary response to you and make things scary. Oh, some beautiful ones here. I'm wildly successful. I'd like to create a truly community space with a blend of new age and traditional. Oh, I'd love to explore some of these further. Excellent. Social justice in our society and our corporate world as well. Beautiful, beautiful. See, beautiful missions that we're all on. For me, I've defined it as my mission or my vision for the world. So how do I make sure that there's enough for all? I came across a few frameworks that I'm going to share with you, which kind of leads to where we've come from in terms of alternative investment structures. Because you think finance, you think investment, you think Shark Tank, right? I'm not Shark Tanky. I don't think so, at least. And I don't want to be Shark Tank. What I do want to be is be aware of what's needed in the world, because if you look at what you're good at, if you look at where you can make money, then the next question is, what does the world need from me? And what I found was the Sustainable Development Goals as a good anchor, an outside anchor for my activities. So I use these Sustainable Development Goals to really look at, okay, what's possible. And if you then look at what the world is going through, the one thing that I clicked into was that we're in the middle of a massive intergenerational wealth transfer. And this is a good thing, right? There's a massive amount of wealth that's being generated. The world has never been this abundant in capital, in people. There's never been as many people on the planet, in resources, natural and alternative resources, in inventions. There's so much abundance around, right? And Airbnb and the business models that you see coming up now actually leverage that abundance. But I'll talk about that a little bit later. So keep in mind that there's shifts happening, mega trends happening in our society. And if you pick up on those, like I did with anchoring on this one in the Sustainable Development Goals, we can actually change things. We can actually have a much more bigger impact than we ever thought possible. So we're in this investment game, and you're like, okay, what is that game actually? Well, we're trying to rig the game a little bit by plugging in net positive impact. Why I say net positive impact is because even though you might have a first degree positive impact, your second or third degree positive impact might not be so positive. Like everyone driving an electric car, the electric car battery needs to be mined somewhere. So the question is to what extent has actually been offset by the driving of the car. I'm not going to go in there, but really what we wanted to see is change the game, right? Where we have a business success, you get empowered, people engage in a collaborative manner. You can share your profits, whereas where my MTP comes in, it's like you have enough, you will share more people will have enough. Virtuous cycle. We actually have investor success, where investors are not this exclusive little club of shark tanky people trying to make as much money by riding on founders' people's backs and stuff. And we have positive impact that actually makes the world a better place by doing the things that we're doing, regardless, right? That really became Epic. So Epic is on a mission to accelerate positive impact by democratizing investments. And we want to do it slightly differently by combining a few things. So we're combining doing good and doing well. The doing good part is the positive impact. And so we look at things quite differently. We look for different type of company. We don't look for the next Facebook. I'm not sure how many Ubers you have on your phone, or how many types of ride-sharing apps or dating apps or social media apps. Like, we don't want to fund the next Facebook or the next Uber. We want to actually help get funding for the next Kiva or the next, you name it, like Tony Chocolonely, beautiful company that's very impact oriented. We then look at exponential scalability. So there's a growth potential in the company. And then we look at a new way of financing these companies for growth. So this is the alternative investment structure that we work with. It's actually really, really simple. But I'll go through why we focus on impact first and what we call zebras. I'm not sure if you've noticed, but unicorns are all the rage, not just with my 5-year-old daughter, but also with investors. So the way that the standard equity model works is that founders have a choice of giving shares for money, getting bank loans, which is hard in early stage startups, and scale-ups usually as well, or grow by bootstrapping and grow organically. Zebras, however, we think are different type beasts, becoming a unicorn. So unicorns are those rare pockets where investors make like bets on 20 companies. It's a portfolio play. It's like gambling, but then I guess more data driven at some point sometimes. And these investors then have a portfolio of 20, and only one of them has to be a wild success. And they focus on profitability, not some and growth. So it's accelerated growth rather than a business basics like revenue, a healthy growth, employee satisfaction, etc. So instead of looking for unicorns, we're actually looking for zebras. And the difference between unicorns and zebras is that zebras actually exist in real life. No offense to unicorns. They're profitable, or they want to become profitable, and they have a focus on sustainability and creating long-term business, right? Usually the founders that we meet that run zebra companies are people that are intrinsically motivated to make the world a better place. That's how they're treating themselves, their employees, and usually their customers and stakeholders as well. And they usually also have quite a community-based and collaborative approach to developing and selling their products and services. So there's a very big difference between a zebra and a unicorn. So we say we hunt zebras, not that we actually shoot them, but we do want to find them and I guess tag them. And the tag would be an Epic brand tag, where the brand would say, this is an impact-driven business, and we expect them to be, and in terms of financial performance, outperforming the average. So we found through research, of course, biased, purposeful companies outperform. And they do this probably because of the intrinsic motivation of the founders' why, as well as the resonance with the market that we're seeing right now, right? The market's become more transparent. People are much more aware of the side effects or the negative effects or the supply chain effects of businesses and products. And these purposeful companies actually actively work with that and try and fix these problems. So we think this A is a bigger market than the unicorn market, and B, it's a smarter bet to have because they outperform. Makes sense, right? Tell me if I lost you, because then I'll backtrack or tweak the flow of the story. Now, if you are a zebra company and you're like, okay, great, but I need growth funding, where do I go? Right? You can go, well, there's a few options. And the options are basically listed on the slide. There's grants. They're basically just financial assistance. They're donor-based money. Luckily, through COVID, there's a lot of donor money available right now. The European Investment Committee is like giving out money most countries have good schemes. So even if you're abroad, you're in good stead to actually find some either really cheap loans from government or grants, specifically if it's R&D and specifically if you can actually measure impact. Then there's loans. Loans can go peer-to-peer loans, or you can have bank loans. Bank loans are much, much harder. Banks have actually been tightening their loan portfolio, so it's much harder to get an actual bank loan. Would also not recommend it. Usually it has to be against the personal liability as a founder. So not ideal. If you want to lose your house, there's a good way to do that. If you do peer-to-peer lending, there's a lot of peer-to-peer platforms in the Netherlands as well. So that's something definitely to look at. Usually it's a cash flow based. So you are stuck with a slightly higher interest rate than the banks. Definitely an option though, if you are an existing concern and you have existing revenues or a solid business model that's been tried and tested. Then you have convertible debt, and that's debt that converts into equity, so shares, at a future price, at a future financing event. That could be a safe note or a convertible note, convertible loan note. Also an option, and then you're back into the equity game. And you have, of course, the equity game itself, so where you actually get money from investors in exchange for shares in your company, usually also some sort of control over your company. So you're not allowed to make certain decisions without them knowing or having their say or steering you in a certain direction. And then you have what we do is revenue-based financing. And I'll talk you through what that is in more detail. Basically, the question then I would have if you're a founder, because I couldn't see if you're setting up or not, what would you like? What would you like to have in your business? And what we found talking to founders is particularly the Zebra founders, is they want to build their business, retain control, beat the odds, make sure that they're highly successful, because if they're successful, they make a positive difference, not just for themselves, not just for their employees, but also for their customers. So if you think about that, and then you look at the financing instruments, not all of them are a good fit to do that. And then the question is, what do angels actually want? They want market-leading returns, use their knowledge to help founders succeed usually, and want to improve society and economy, usually quite localized and or on specific themes. So investors that do the equity game are quite narrowly focused. They don't necessarily want to do this for everyone all the time. And they want to see returns that are much, much higher than what you'd expect to get from, say, putting your money in a bank account or in a peer-to-peer loan. There's some problems with the angel model and the equity investing game. And I won't necessarily touch upon the other issues with the other instruments, but I want to focus on these ones because we see revenue-based financing really as a stepping stone or a complementary instrument to equity investing. So the problem with equity investing is if you give your shares as a founder in exchange for an investment to outside investors, there's going to be a debate and or a discussion about what your company's worth. We call it the valuation. So you think you're $5 million worth because you have a great idea and it's amazing and it's just, it's the best thing since sliced bread. You have a stellar team and you have 2 customers. Your angel investor is going to go, this is a super high risk investment. I don't like the market that you're in. And if you want me to invest, I peg you at $2 million. Massive gap. You're going head to head. It's a valuation. It's totally arbitrary. There's no set standard rules that you can calculate your valuation based on. You can't really, it's kind of like Fingerspitzengefühl or blink capability of angels that go, yeah, you're about this much, right? There's ranges, of course, where you have pre-seed, seed stage, series A, series B, etc. But even so, it's all about perception. Then the second problem is that with equity investing, your newly found investors are focused on hyper growth as much as possible, and an exit event in the future, which means that they can actually get their cash that they put in out again, because in equity investing, shares on a private company is private market. So you can't just go to the stock exchange and sell them. It's impossible. So basically, they want to find an exit pathway, and an exit pathway usually in the first 5 to 7 years. You, however, specifically as a zebra company, want to retain control, want to make sure that you make your impact, and you're not really worried about getting out of the business because you love the business. It's what you want to see in the world. It's like your intrinsic motivation. It's what gets you up every morning. So why would you want to exit that, right? There's always a difference between an investor exit and a founder exit. But given that that's not necessarily always aligned, there's a misalignment of goals. They're also going to be worried, the investors, about what you're spending your money on. So if you want to give yourself a pay rise because you have a child, for instance, or you actually finally can breathe a little bit, or you want to pay back your own director's loan of the money that you put into your own company, your investors might say, don't do that. That doesn't make sense. We don't want to have that. We want to just have a loan on the books. Misalignment there, right? Because you're like, well, I've got to survive. So there's always going to be friction there. Then there's a loss of control for the founders. Usually after 3 rounds of equity financing, founders are back in an employee type position where even though the company's worth much more, their shareholding is less than half the company. So in essence, if the political game gets played by investors, by your shareholders, they could actually fire you, or they could buy you out. Basically, you don't own your company anymore. So you're back in an employee type role. And the fourth issue is that the investors are locked in for the long term. So unless you raise a next round, which means unless you become more profitable or more valuable in terms of evaluation and market perception, you, as an investor, can't get out of the investment. So it's an illiquid asset, as we call it in finance terms. So the investor's locked in. So they're going to push you to have some sort of exit event. All fun and games. Doesn't necessarily feel like it's working out well, right? It's not necessarily also fair, given that as a founder, you're putting in all your blood, sweat, and tears. And these guys are taking the majority of your shares after a while, and because they have the money. So we're like, okay, we see this. We see the trend of the sustainable development goals. We see the fact that we've lived the fact that as a founder team, we love working on things that make us passionate. And then we found revenue-based financing as an alternative. So what it is, it's actually really simple. It's similar to royalties. What it is, it's basically where investors put in a sum of money, and then you agree with the founders a predetermined multiple or a predetermined extra interest, so to say, or if you put in $100,000, you put in a 3 times multiple that gives you a return of $300,000. You agree that with the founder. It's a high risk investment. You have revenue, and you basically make the deal that every month or every quarter, the company that you invest in pays the investor 5% of every sale. Whether that's 2 sales, 15, or 5,000, doesn't matter. And that contract continues until that predetermined amount of 300,000 is paid back. That's it. It's that simple. You're kind of going, well, what's the downside? Like, what's the catch potentially? Catch is it doesn't work for everyone. There are some advantages in that revenue-based financing works because it takes out the interest rate that the bank normally charges, right? Normally, if you get a bank loan, your bank goes, I'll give you $100,000, fine, but every month you have to pay me back $7,000. I don't care what the business does. I don't care what the market does. I don't care if COVID has arrived. You have to pay back $5,000. That's not the case with revenue-based financing. It actually moves with the growth of your company. So it gives flexibility to you because you know that no more or no less than X% is taken out of your margin. It's also not secured against assets. So instead of saying, okay, I've got a personal loan here, or I have to give 25% of shares, or I lose equity control, or as a founder, I get diluted in my shareholding position. Also doesn't happen with revenue-based financing. The biggest upside for revenue-based financing investors is that you, as an investor, get your money back sooner, which means that every month or every quarter, a notification comes in with a report that says companies earned $10,000, you get 1,000. Awesome, because if you invested 100,000 and you get $1,000 back in the first 6 months, say, that kind of works because you're kind of like, well, they're doing a thing, right? And as an investor, if you know people who want to use that service, you're driven to actually connect them to the company, because if they make the sale to your friend or to your family, whoever, to your business connection, there's a return for the investor. It's like an affiliate fee, but then better, right? So, excuse me. What we do as Epic is we actually broker these deals. So we find and broker deals that are focused on impact, they're at or near revenue, and that have a profit margin and scalability. And why we do this is because we want to have, our big secret dream is that we want to divert as much risk capital in the market as possible to impact-based businesses. We think that we're opening up a pool of companies that have not been looked at from an investment perspective before. We believe that this is a high growth market overall, globally. It's going to only get bigger. And we know that the system can work as a supplement or as a complementary instrument. So you might be wondering, what's the downside? Downside is it doesn't work for all companies. So as I said, profit margin above 30%. There's a reason for that. It's not because investors are greedy. It's because you as a founder won't be able to sustain a 5% top line takeout. Basically, you cut out 5% of your top line. So 5 cents on every dollar or euro that you earn, if you have a profit margin of, say, 5%, because then your profit margin also drops to 5%. So basically, you don't make any profit. So you need to protect your profit margin, and your profit margin needs to be big enough to carry the revenue share. Right? The other downside is it takes out some of the working capital, so it might take longer to get to profitability for a company if they're in the unprofitable stage at the moment. And the model that we use, it's the system itself is super flexible, so you can actually do revenue-based financing with any business. You can do it with your friend who's setting up a business and wants to get $1,000 in seed funding. You can say, okay, you'll pay it back, no interest, whatever, pay it back based on whatever you make that month for the next, until you reach the goals, basically. It's that simple. Anyone could use it. Like, seriously, it's like a loan. What we look for, though, is a 5 times multiple. So what that means is that for every $100,000 or $100 that you invest as an investor, there's a $500 return over time. And if we want to play with the big boys, which we intend to do, and we want to disrupt venture capital, which is the game where you have the portfolio of unicorns, potential unicorns, then we need to actually outperform the unicorn game, which means that a 5 times multiple in 5 years is the internal rate of return of 38%. That's what venture capital people look at. So if we're there, right, if we can achieve that with companies that have impact, that company needs to have sustainability and scalability in their business model. So I'll talk a little bit about what we mean with scalability, because it is a vague term, right? It's like, what does that mean? And what we've done is we've partnered up with OpenEXO. I'm not sure if you've heard of them. It's basically a community of about 5,000 people globally. They're mostly consultants, founders, investors, coaches, and it's based on exponential transformation. The book was written by Francisco Palau and Salim Ismail. So they're the founders behind the community. And it basically lays out exponential organizations. The first book lays out the 10 attributes that highly scalable companies have. So 6 years ago, Salim has done the research in Silicon Valley, etc., has codified what it means to scale exponentially. And what came out was this, the EXO Canvas. If you go to www.exocanvas.com, you can download it and you can understand all of it. If you go to openexo.com, you can join the community for free. There's courses in there as well around exponential scalability, etc. But this is the framework that we use to look at companies and go, how scalable are you? So a company can be exponentially scalable, and they have an internal look and an external look. So internally, they look at the scale acronym. Externally, they look at the abundance acronym. If you look at I can walk through them briefly, but if you look at the top, there it says MTP. MTP stands for Massive Transformative Purpose. Now, this is very, very similar to your why. So for yourself, you've already defined your massive transformative purpose potentially. So well done, you. If you take anything away, take that home. Write it down, put it on a post-it, put it in the bathroom so that you look at it on the mirror or something. It's like, why do I get up every morning? That's why. For companies, you can have the same massive transformative purpose. So for Epic, it is accelerating impact through democratizing investments. That's our massive transformative purpose. We want to see impact, actually positive impact, accelerated in this world. And we do that through redirecting risk capital. That's our game. Now, if you look at the canvas then in itself, there's 10 attributes, and a company is exponentially scalable in these terms if they have 4 out of the 10 attributes. Now, I don't have time to walk through them all, but if you do have questions, let me know, because I'm happy to walk through some elements, but I would highly suggest that you look at these elements if you own a business and ask yourself to what extent is scalability and growth, and to what extent are you tapping into abundance from the outside, and to what extent are you actually able to scale your business. And so these elements are all described on OpenEXO, on the EXO canvas. You can play with it. You can play with your business model, because the EXO canvas basically works next to business model canvas, for instance. So this is a really handy tool for anyone to have, and ask yourself, how easy is it for us to really grow rapidly, right? If you put like Airbnb on this, or if you put Instagram on this, you'll see that they have many of these features. And the books actually describe it as well. Now, I'm going to walk you through a case study. I did see a question. Is it possible to combine different types of financing? Yes. So Yara asked, can you do a hybrid of equity financing and revenue-based financing? 100%. So there's a few ways you can do this. We are currently raising a round for Abby, the company that, the GoGoTech, the company that you're seeing in the slide. We've just closed it actually, and they're raising a first round of revenue-based financing. The value proposition that Epic has is that we actually find the investors, but we also find the network and we help them scale. Right? That's the trade-off. So we help them find the investors, but we also make money off them, because as they raise money, we take a success fee from the founders. Very similar to normal crowdfunding. But they've done that because they saw a strategic partnership in us, where we've leveraged the OpenEXO community already. We found the investors, etc. We've just closed a round of with 140% subscription. So that was a success. They're at the same time raising a safe note. So equity financing, where it stands for a standard agreement for future equity, SAFE. And that safe note is linked to a valuation. Now we didn't even discuss valuation because it's not relevant for revenue-based financing. It takes out all the noise around, is my company worth 2 million? Is my company worth 5 million? If it's 3 million, what's my founder position? What's the dilution rate? What does it mean for my family and friends that have invested and I've given them shares and all that sort of fun stuff? Nothing like that. The safe note doesn't necessarily have that much either, but it's against a future valuation. It's usually a capped valuation as well. So they're doing a safe note, I think, of about 2 times the amount of the revenue-based financing. So they're looking for about 500,000. The revenue-based financing was around 150. So that worked, and it works well. The one thing that we have noticed is that the financing instrument of revenue-based financing in Europe is relatively young. So people in Europe are not necessarily aware of it and don't necessarily understand it. It also kind of works against the whole, but what about the valuation discussion in people's heads? So investors go, yeah, this is great, but what about the valuation? We're like, we don't want the valuation, we just want cash flow. Like, okay, but shouldn't we debate the valuation at least? I'm like, no, because if you think it's a good bet, it's a good bet, and this is one way to invest. It's another instrument, so they can work together. We also have contact with an accelerator, Fledge Impact Accelerator in Seattle. They do work globally, and they invest based on that mix. So they do seed or pre-seed investment, really. They give a small cash amount. They then walk people through the accelerator, and they take 6% equity. And they've seen all the colors under the sun in terms of new financing instruments coming online post their revenue-based financing instrument. So it totally works. Is rapid growth or meaningful growth more important? How would you measure the two? Good question. I guess growth in our terms is revenue growth. There's an underlying assumption there that with every sale, you have more impact. So impact is directly linked to number of sales. That makes sense? So meaningful growth then is the same, or growth is the same as meaningful growth because the impact is linked. So I've had this debate not just once but twice. It's like, well, what do you mean with meaningful growth, right? What is meaningful in a rapidly changing, always uncertain world? And so it's been interesting because the impact focus in the impact world, profit and profitability and growth are almost seen as dirty words. Like we've been to a convention, it was focused on elderly care, and there were all these impact-driven companies, and they were mostly either close to nonprofits or community-driven initiatives or for-profits that are cooperatives, and they didn't necessarily want to have a full-blown, scalable product, which to me is counterintuitive, because as soon as you have something that's great and that has a great impact, you'd want everyone to have that with the same problem. So then is it a bad thing if that grows rapidly, right? But it's, again, the underlying assumption is that with your product, there is impact. So if you grow the sales of your product, you multiply your impact. I hope that kind of answers it. This could be an existential debate, honestly. It's a fascinating space. But to give you the example of GoGoTech, we literally this week has been knee-deep in paperwork to close the investment, which I don't want to actually bore you with because it's extremely painful to do contracts across borders. GoGoTech, I'll post some links in the chat before we end this session. But basically, GoGoTech has developed a wheelchair with the focus, with the mission to have an inclusive society. So currently, wheelchairs, electric wheelchairs in particular, usually are only given to people that have a really expensive insurance in developed countries and have basically money, right? I think there's like a ridiculous amount of wheelchairs that's not being used, like manual wheelchairs, because there's nobody to push the people. So then the question is, how many people can actually push themselves? Also not many, but because if you think about it, right, we're in a graying society, obesity and all these like wealth associated diseases are getting worse, but we don't necessarily are attending to what that means for our insurance systems, etc. So Abby or GoGoTech said, okay, this is not such a good thing. We don't want powered wheelchairs only to be a privilege for the wealthy and the well-insured. We want it to be accessible to most people in the world. Now, so they've developed a chair that has all those smarts that your robot vacuum cleaner has. It has a software platform attached that can actually be hacked or be used by third graders. And the idea is to grow both the platform, the mobile apps, and the chairs, basically the chairs features, like physical features, at the same time, based on feedback loops with the actual users. So some disruptive elements are listed here, but basically instead of weighing about 90 kilos, this chair weighs 25. It has quick release, so you can literally fold it up, take the batteries out and put it on an airplane. Also mostly not possible with the big chairs, with the big electric chairs. There's a possibility to have 2 batteries so that you can charge it with a USB, which means that you can go to a Starbucks as a person in a wheelchair and come back by yourself without running out of charge and the fear of running out of charge. I'm not sure if you guys have this, but if my battery turns red, I go, oh my God, I need charge. Imagine if you were in a wheelchair and your wheelchair has that. Like, that would be horrendous, right? So these features all are possible, put in a wheelchair, literally in a wheelchair. And then they're selling this on the market, not as a wheelchair that goes through insurance, where then it gets bought by third parties, the middlemen, basically, before it gets to the end user. This is direct to consumer. So also in the business model, it's disruptive. And basically, what we've done with them is we've structured a revenue-based investment opportunity where there was a minimum investment of $100,000. This is US. It's a Thai company. And in exchange for the $100,000, the investors collectively got 2% or get 2% of gross revenue. We've agreed on a 5x multiple in 5 years, preferably, but the 5x multiple holds. So as soon as they pay back $500,000, whenever that may be, in portions, cumulatively, over time, that's when the contract finishes. On top of that, we took the opportunity to take 1% equity. And the 1% equity, we call it the exponential ripple of impact, because this is the stuff that, if this company actually grows exponentially, like we envisaged it to do, their equity will become much, much more valuable than the revenue-based contract. Totally fine. So we take 1% of equity. We have the option to take more equity, but we don't want the equity. We want the cash flow because we don't want to have control, and we don't want to be in the equity game, because then we're basically back at an illiquid position where we have to start caring about what they spend their money on and where the exit is. Whereas this contract will run until the 5x multiples returned. Then it's finished. The 1% that we keep is for the opportunity that if this company does become the next thing since the best thing since sliced bread and becomes akin to a Facebook or, I don't know, GE Electronics, right? We were not the idiots in terms of the investor pool. We're not the idiots that only took a revenue-based financing loan. That's the one reason. It's like, if there is an exponential ripple of impact with this company, the investors that took the risk at the start get a small upside reward, basically. So that's basically what revenue-based financing is. It's an alternative to equity financing. It's an alternative to bank loans. It's an alternative to grants. It's not for everyone. If you don't have revenue, it's probably not good for you right now. If you don't have, if you're not going to be near revenue or need a lot of development investment, R&D, like with deep tech, it's also not for you, because this really works on revenue. The bigger the risk of the company, basically, the more likely it is that the equity instrument is still the best bet for investors, because that is the game of the portfolio. Whereas we're saying we don't necessarily want to play the portfolio. Success for us is every company survives and grows sustainably and actually has an impact, because it's all about accelerating that impact, the positive impact on the world. So that's it for me, really. Feel free to ask me any questions. I'm sad that you can't just jump in and ask the question or have a conversation, because I love conversations. I love connecting with people. And I'm also a little bit sad that the platform doesn't allow us to put emojis in, because I would love for you to share how you feel after this talk. Is this something that resonates? Are you totally confused? Just put your comments in here, no judgment. This is all feedback from me. I believe in feedback loops and keeping them really tight. So give us all you got. Share with us how you're feeling about revenue-based financing, about your founding journey, about investments, about the lingo. Give it all to me. I'm very much open to any and all feedback. So please do that. And other than that, the floor is yours, really. I can talk forever about this stuff, but I won't bore you necessarily. Super cool. Very well explained. I'll take that. Thank you. Great. Yes, one word. Tell us how you feel. New way of financing. Yes. Lovely. Well, make sure to move a little bit before you go into the next session. Warm up those feet. Get the blood flowing. Because, we're our best if we show up as ourselves. So, awesome. Informed. Interesting. Yes, freedom and flexibility, indeed. Now, if we can overlay some of that with the actual stuff around, having people being more grounded and nicer to each other and more aware, that'll be even more awesome. I have actually seen a venture capital firm that pitches like that. They're like, founder mental health is our differentiator. So really cool things happening in the world. Do keep looking out for the good stuff. If it doesn't feel right or if it doesn't feel fair, that's probably a good sign to walk away if it's not aligned with your values. So cool. Oh yeah, I'll put the links in. Let me see. EXO Canvas. And then we have OpenEXO. It's all about exponentiality. If you know anyone who wants an electric chair for less than $2,000, they can order it at gogotech.co. They're also on Facebook, and the product is called the Abbey. I'm not entirely sure why they call it Abbey, but it's now like it's a person. It's a baby, which is quite adorable. Actually got started by the founder. He was in a wheelchair himself after a really nasty motorcycle accident for about 6 months. So he's experienced it all. And his other co-founder had they're in Thailand. He had a beggar living next door to him, or like on the street basically. And they were trying to develop a hoverboard for him because he was from Cambodia and he had his leg blown off by a mine. And like, well, how can we help you? It's like, well, there's many people like me. Why don't you do something? But the hoverboard was really hard to control for people that couldn't stand properly. So they decided that a wheelchair was better. So this is the origin story of Abby and the Gogotech team. And I think Estelle already shared the link for the website, epichub.org. That's us. Let us know how we can help. I'm here to help founders that are impact-driven to become fundable and or get funded. We are a global team. We work across borders. Feel free to reach out. Find me on LinkedIn. Spam me. I will get back to you at some point. Might take a little bit, but I'm usually around at some point. Estelle, do I need to do anything else? Should I put you back in? Wow.
I think when your screen share is on, then you can't. Then I can't enter back in again. But thank you so much. Really, really great session. Learned a lot. And I hope that everyone else found it as interesting, and we will definitely get in touch. And thank you.